All right, can everybody hear me okay? Awesome. All right, let's do this. All right, today is the 7th. And this is going to be the ERY discussion. Yesterday we bought the Feb 4044 call spread for 90 cents. Stock was 37.50. Okay, currently the stock is 39.20 and our spread is trading $1.20. And we are offering half of position at $1.30. Okay. The only reason we're offering half at $1.30 right now is to take, close to a 50% profit on half of our position overnight. Okay? 40-cent profit overnight. Okay? What else could we possibly do if we did not want to exit half? If we still believe that, looking at this chart here, we were buying this bottom support area and looking to, get that pop up to at least 40, if not higher, probably to this, 41-ish area. Okay, what could we do? Well, we could turn this into a butterfly to collect premium. It would certainly cap our upside if the stock really, really ran, but we can absolutely collect some premium against that. Sell another 44, buy a higher call. David, that would be basically turning it into a butterfly. So here is our current position. Okay, if we were to just turn this into a regular, normal old butterfly, okay, what we would want to do is sell the 44.48 call spread in February. We could do that for about 65-70 cents. Okay, so what could we possibly do instead to hedge the position? So one, we could sell the Feb 44.48 call spread for basically, let's call it 70 cents. Okay, if we did this, we would now have the Feb 44.48 call butterfly for a price of 20 cents. Right? Everybody see that? Okay, and if we did that, we still have a lot of upside exposure. It's probably trading 40 to 45 cents right now, but what we have done is we've really minimized our risk to this butterfly, to our position, right? The most we could ever lose now is 20 cents. And we could still, at a perfect winning spot of the short strike at 44, this thing could still max out. Okay, so we could do that. What else could we do? Anyone else? Well, how would we, what kind of calendar, David? Remember, this is not just a long option we have. This is a vertical call spread that we have. So when you say calendar, what would we actually do? Anyone? David, anyone? Well, I will tell you that there is really not a way to turn that into a calendar other than turning it into a calendar spread. Okay, Barry, we can do that also. We can sell a different call spread. It would be similar then to making it into a butterfly. But let's look at what Barry's suggesting here. Instead of selling the 44.48, what if we sold the 43.47? Okay, well that's only, maybe a nickel more. Okay, so I probably wouldn't do that because I would not want to complicate the trade for an extra nickel, right? If it were significantly more, 15 cents, 20 cents, that's one thing. But for a nickel, probably don't want to complicate it. Okay, so what else could we do? And it does kind of go along with what David said. So what else? David said calendar. Anybody want to throw something out that could turn this into a calendar spread? Anybody? Bueller, anyone? Did I lose you guys? Please tell me you can still all hear me, because I don't see anybody responding, and I'll be happy to just, turn this off. Okay. So what are the ideas, guys? All right, Deborah, change now you're on to something. So you said change one of the dates. So if we were going to turn this into a calendar, we're already long a spread going out to February. So we might want to sell some sort of spread that expires next week in January. Okay, so with ERY trading where it's at right now, basically 39 and a quarter. Okay, what is the expected move going out to next week? Awesome, Brian. Okay, right now the expected move going out to February is it's perfect for us. The expected move is $6.30. Potentially put it way above our short strike, so that's great. Okay, Deborah's got it. So, yes, it's about a $3 expected move. So, basically targeting 42-ish or so. So, what if we did something like selling the 41.43 call spread? Not $4 wide, but just $2 wide. We could collect 40 cents for that. Okay. We could sell the Jan 41.43 call spread for 40 cents. We could move that up a strike, and let's see what we could possibly get for the 42.44. Shouldn't be as much, and it's not. You can see maybe you could get 30 cents, but probably 25 cents. No, Rob, right now there's not. we could sell the Jan 42-44 call spread for 25 cents. These are all just additional ways to look at hedging some of our risk, hedging some of the long premium that we have. Or we do nothing. Okay, or we do nothing. So, of all of these on the board here, of these three possibilities on the board here, okay, what do you guys think makes the most sense? Barry, it's not out of the box. We could absolutely do something like that. That's called a pairs trade, P-A-I-R-S, not pair like the fruit, where you're matching up two like or similar sorts of asset classes, or they could be completely opposite also, but you look at a correlation, what's called as beta correlation. We could definitely do something there too. Again, my goal is to keep this as simple as possible for people. So, John, if you read what is on the whiteboard here, the notes on the whiteboard, we're talking about the position we got into. Okay, we're talking about what we're currently trying to do is offer half our position at $1.30, and then we're looking to possibly do something else instead of that if there's something better. So, Fong, that's a great question. If we were to sell the 41.43 for 40 cents, we normally would never on its own just sell that, right? Because a $2 wide spread, sell for 40 cents, have risk of $1.60, right? We would never ever do that. However, remember, this is a hedge against a long position that we already have. So it kind of, makes a bit of a different circumstance than just initiating a new position. Well, Mickey, something like this just comes from experience. You're not going to have any sort of indicator that, pops up and says, okay, do this to hedge your position. This is just a matter of experience. So if we bring back this chart from yesterday, guys, on ERY, okay, when I look at what the next area of resistance might be, okay, in addition to what we just calculated as the expected move, I see probably somewhere the bottom of this volume area where there was some major support in the past, here and really here. I kind of see that as the next area of resistance to the upside. So somewhere around 40 to 41. And then I also see beyond that, and we looked at this yesterday, some big resistance right in this area here. Not only is it the major volume zone, that's this, inside of the yellow lines here, that's the big red line coming through here, but there's also the 50-day moving average, the 200 right above that. That's perfect. That coincides right with, our short strike. If we were just to kind of let this thing roll, that's perfect. We're looking to hedge a little bit, though. So when I look at this resistance area of about 41 right here, coupled with the expected move for this week, I kind of like selling the 41.43 for 40 cents. Maybe we even try and get 45 cents out of that. I don't have that on here, Mickey. You can look it up pretty easily, I think, or it might be on the. Hang on, it might be down here. Yeah, 38.774. So, David, that I wouldn't do. Why wouldn't I do that? That's not the VWAP on there, Mickey, because the VWAP is 38 and change, which is down here, and this is up at 43. David, what do you mean the third? That's what you have. What do you have? And why wouldn't I want to do that? Well, no, that's okay, but I don't want to sell a lower strike than what we already have on, because now it takes out any upward momentum. Remember, we're long the 40 call, right? We have the 40-44 call spread. So I don't want to sell a lower strike, which is actually going to give me some negative delta and actually hurt my spread to the upside. True, I could get more premium for it, no question about it. Does everybody understand that? Or, we do nothing. But again, what I'm trying to do is just show you guys and teach you options, no pun intended, options of what we can do to hedge our position. Or not only to hedge it, but to increase our profitability while at the same time minimizing the risk. Right? That's ultimately the goal here, is to max our profitability while minimizing our risk. So let's take a look back into the Jan 41.43 here. And that thing's trading, we said 40 cents. I don't know, right here we're not going to get any more than 40 cents for it. If the stock goes up a little bit more, maybe we can hold out for 45 or 50. Or if we go out to our Fed position and again try and sell the 44.48 to just turn it into a regular butterfly, pretty sure we could get 70 cents for that. I don't know, we could certainly hold out for more. Or again, we don't overtrade and we just say, okay, we have an exit signal out there for half of our position. Okay, for half of our position, take some profits off and let the rest kind of run for a little bit. So those are all the choices, options that we have, at least that are on the board that we're discussing. And we need to just kind of look at that and say, okay, what is the potential best opportunity from that? Okay, what do you guys think? I don't know that there is a complete right or wrong answer to it. So with the current spread we have, Marcus, we can do that. And we have that exit signal out there for half the position and then let the rest go. Chesky likes the butterfly, where we're now hedging 77% of our position, right? Because if we paid 90 cents and we're collecting 70 cents, that's the risk that we're taking off the table. So Dennis, let me ask you something. Why don't you see ERY moving to 44? And I'm not saying that I agree or disagree. I'm just trying to ask why you say that. So the profit potential, John, is the same if the stock goes to 44. Okay? What it does is it reduces the profitability if you go over 44. But that is the risk you're taking for taking risk out of the position. Okay, well, that's part of the reason we're doing this, Dennis, is exactly because of the situation. Right, we're trying to take advantage of the situation. No question, some news can come out, God forbid, and oil can spike up, which would make this position go against us. David, we can do that too. That is certainly an option as well. Well, Walter, as you can see on the whiteboard here, we're looking at a few different possibilities. So let me ask you something, Rob, and I don't disagree. Why did we get into this position then in the first place? If we think the opposite is going to happen, why did we get into this position? Anyone? Because there was opportunity based on technicals, based on this coming down to massive support. There's always going to be something that can happen, whether it's an earnings report, whether it's the conflict with Iran, whatever it is, the trade talks, right? We could get a tweet coming out of the White House right now saying the trade talks are off. Right? So that is all news that we always have to take that into consideration. But if we were to handcuff ourselves and only trade on certainties or opportunities where, oh my God, I can't, something may happen here, so I don't want to trade, we would probably never trade. However, that is why I'm being a little bit more aggressive right now into looking for some sort of hedge to our position. Normally, we look for, you know, a 70% return, so we're not even close to where we'd like to see profits typically in a stock like this. But because of the additional, you know, risk that's out there, we're okay with taking a little bit off the table. Again, I'm looking to see what is the best possibility for all of these options. All right, so I'm gonna, you know, for right now, we're gonna keep what we have in place, but I may change this actually. I may change this. I'm just gonna look a little further into this, but I really like the opportunity. What has also helped us since yesterday is what? What haven't we talked about yet that has helped our position since yesterday? Anyone? Bingo. Bingo. Nope, Marcus has it. We haven't talked about volatility, and what has happened since yesterday? Well, volatility is up 3.5%. That's a really good thing for us. Why is that a good thing? Well, it makes our current spread a little bit more expensive, and what it also does is it raises the price of options so that if we want to now sell something as a hedge, it has made it more expensive. So good job, Marcus.
It's amazing. I'm learning how the brain works, but not just any brain, but my brain.
So, you know, I'm looking at this here, and quite honestly, if we could get 30 cents for the 42-44 spread, I know I had said 25 cents before, but if we could get 30 cents, I'm kind of leaning towards that, guys. All right, any questions here, guys, before I turn off the recorder and the mic and get this populated up here? Yes, no, maybe? Okay. All right, let me get this populated up here, guys. I'll be right back.